Okay, so let's dive into this.
Sounds good.
You've been carefully building that investment portfolio, and you've got your eye on the hot new tech stock that everyone's talking about. But then, oh no, the Fed hints at another interest rate hike.
Right.
And suddenly you're second-guessing everything.
Yeah.
So is it even possible to chase high growth without worrying about everything crashing down?
Yeah, it's a real dilemma, and
Yeah.
it's exactly the type of thing that Dan, a partner at Karani Asset Management, tackled in his interview on Global Money Talk.
Okay.
He argues that trying to get this perfect economic scenario with crazy growth, low inflation,
Right.
and low interest rates all at the same time is pretty unlikely.
Okay.
Something's got to give,
Yeah.
and it very well could be your investments.
So no magic formula for economic bliss.
Right.
But what does Dan Haas suggest that we look out for?
Mm-hmm.
He had some charts in the interview, right?
He did. And they're fascinating. He starts by pointing out that all that initial market euphoria
Oh, yeah.
after the election has kind of fizzled out.
Yeah.
Remember that crazy Wednesday when the S&P 500 had its second worst day this year?
Yeah.
That's the market reacting to what the Fed's signaling about interest rates.
Yeah, that got my attention for sure.
Yeah.
Pro-growth policies all sound good, when
Right.
you just read about them. But as Hobb points out,
Yeah.
those predictions don't always line up with what actually happened.
Exactly. His first chart really shows this. It shows that companies with huge growth rates rarely keep up that pace over time. It's kind of like a sprinter who smashes a world record.
Uh-huh.
Yeah, they might win some more races, but they're not going to keep breaking records forever.
Right.
Things eventually even out.
Okay, so how does this work with, like, my own investing strategy?
Mm-hmm.
Should I just completely avoid high-growth companies?
Not necessarily, but you shouldn't just chase the newest hot stock just because it's making headlines.
Okay.
Instead of look for signs of sustainable growth. Like, does the company have a unique product or service,
Right.
something that solves a real problem? Do they have customers who love them? And a solid history of innovation?
Okay.
These are the things that suggest a company's growth is here to stay.
Okay, so sustainable growth is key. What about profits?
Mm-hmm.
I mean, because profits are what it's all about at the end of the day.
Absolutely. And that's where Hot's second chart comes in. It shows how those excess returns,
Okay.
those profits that are more than a company's cost of capital, tend to get smaller over time.
Okay.
It's classic competition. When a company finds a crazy successful product or service,
Yeah.
competitors jump in and try to do the same thing.
Right. Everyone wants a piece.
Exactly.
Yeah.
So that initial profit boost gets smaller and smaller as more players enter the game. And this chart is super important for you as an investor because it shows you just how important a durable competitive advantage is. They call that a moat.
Right.
Can the company protect its profits over a long period?
Mm-hmm.
Do they have something special, like a really strong brand, proprietary tech, or a network effect that's tough to copy?
Makes sense.
Mm-hmm.
So it's not just about chasing those huge growth rates or the most profit right now.
Right.
It's about finding companies that can hold their own and keep those profits coming even when things get competitive.
Exactly. And that leads us to Haas' third chart, which focuses on the idea of reversion to the mean
Okay.
when it comes to a company's sales growth. I know this might sound a little technical, but stick with me because this directly affects your portfolio. This chart basically shows that no matter how fast a company grows at first, things tend to balance out over time. So companies growing super fast will probably see that growth slow down,
Right.
while companies growing slower might actually see it speed up. The market has a way of kind of normalizing things.
So it's like a pendulum. Even the biggest swings end up back in the middle.
Exactly. That's a great way to put. And this understanding of reversion to the mean
Okay.
is so important for investing for the long haul. Don't get caught up in the excitement of the moment. Look for companies with solid fundamentals and a history of good execution because those companies are better equipped to deal with the market's ups and downs.
Okay, so these three charts are all kind of like warnings, right?
Right.
Telling us not to get blinded by what's hot right now. But how does this reversion to the mean actually work in the real world? I mean, there's always some new sector or company that's doing amazingly well,
Right.
at least for a little while.
Yeah.
So how does that fit in with this idea?
Right. That's where Haas's ideas about skill and luck get really interesting. He says that skill, you can repeat that, and it can drive consistent results. But luck, luck is, well, fleeting by its very nature.
Yeah.
Even the best CEO or the most innovative company can't control everything that might affect their success.
Okay, so it's like a basketball player.
Right.
They could be an amazing shooter,
Right.
and they can practice their free throws all day long. but they can't guarantee they'll make every shot.
Right.
There's always some luck involved.
Exactly. And this difference between skill and luck is really important for you as an investor.
Okay.
It helps you avoid just chasing the next hot thing
Uh-huh.
and instead focus on companies with a proven track record of skillful execution. Look for managers who have made good decisions time and time again, navigated tough situations effectively, and made money for their shareholders.
So past performance isn't a guarantee.
Right.
But it can show you how well a company can adapt and do well even when things change. This makes me think about those big tech companies that are ruling the market.
Right.
Especially those Magnificent Seven stocks. They've been doing amazingly well.
Yeah.
But can that kind of performance really go on forever?
That's a great question, and Haas addresses that head on.
Okay.
He knows how incredibly well these tech giants have been doing. But he also reminds us that even the most successful companies can see their growth slow down.
Yeah.
Or even their profits go down.
Okay.
Especially if they've been riding a wave of good luck.
It sounds like he's optimistic about their future, but he's not getting carried away.
Right.
So what makes him feel that way?
Well, Haas points out that companies like Microsoft, Apple, Google have become so woven into our lives and our businesses that they're almost like modern-day staples.
Okay.
Think about it. Who's going to get rid of their Gmail or switch to a whole new operating system just to save a few bucks?
Right. These services have become so important that we're willing to pay for them even when things are tight.
Yeah, they're practically like utilities or healthcare at this point.
Exactly.
And that's why Haas thinks these tech giants are in a good spot for continued growth.
Okay.
Even if it's not as crazy as what we've seen in recent years.
Right.
He says that instead of looking at the short-term ups and downs, we should ask ourselves, are these companies making things that people really need and will pay for, even when times are tough?
So instead of getting caught up in the hype, we should be looking for companies that are doing something useful and solving real problems.
Exactly. It's about long-term staying power, not just making a quick buck. And that brings us back to what Haas says about focusing on quality and valuation when you're looking at investments. He suggests that in a market with so many potential problems, you should zero in on companies with a solid track record, a real competitive advantage, and a price that makes sense.
Hold on. We keep saying quality companies.
Right.
Can it break that down a little more? What does that actually mean?
It's a great question, and it's really important to understand what that means in real life.
Okay.
When Haas talks about quality, he's talking about companies with those strong moats, the ones we discussed earlier. They've got something special that makes them different from the competition. So if it's a powerful brand, special technology, loyal customers, or a mix of all of that, these are the companies that are built to last.
So it's not just about looking at their financials. It's about understanding their business, who they're competing with, and if they can make money over the long term.
Exactly. And just as important is valuation.
Okay.
A high-quality company can still be a bad investment if you pay too much for it.
Right.
It's like buying a house. You wouldn't pay $1 million for a tiny shack.
Yeah.
Right?
Right.
You want to make sure the price you're paying is worth the value you're getting.
So how do I know what a reasonable price is for a company's stock? This is where things get a little tricky for the average investor.
You're right. It can be tricky, but there are a ton of resources out there to help you understand valuation.
Okay.
There are websites, books, financial advisors who can help you look at a company's numbers, compare them to other companies, and figure out if their stock price makes sense based on their earnings, their growth potential, and other factors.
So it's about doing your research, not just following the crowd or the latest headlines.
Exactly. And that brings us back to Haas' idea about putting your money into a smaller number of these top quality companies.
Right.
It almost sounds weird, doesn't it?
Yeah.
Don't we always hear that diversification is the key to matching risks?
That's what I thought.
That's a pretty common misunderstanding, and Haas tackles that head on.
Okay.
He says that while diversification is important, putting your investments in a few truly great companies that you really understand can actually reduce your risk, especially if you've done your homework on quality and valuation.
So it's quality over quantity.
Yeah, that's a great way to put it. But it's not just about picking a few companies and calling it a day.
Right.
He emphasizes how important it is to really understand the businesses you're investing in.
Okay.
Are they run by good and ethical people?
Mm-hmm.
Do they have a clear vision for the future?
Yeah.
Are they adaptable and innovative?
Right.
These are the types of questions you should be asking yourself before you invest your hard-earned money.
So it's about being an informed investor.
Exactly.
Not just sitting back and watching.
And remember, investing is a marathon, not a sprint.
Mm-hmm.
Don't get discouraged if you don't see results right away.
Okay.
Keep your eyes on the prize and be patient.
This has been so helpful, and
Yeah.
I feel like we've covered so much.
We have.
But before we wrap up, is there one final piece of advice that Haas gives us?
Mm-hmm.
Something that will help us deal with the constantly changing world of investing?
Halle emphasizes how important it is to be adaptable.
Okay.
He reminds us that the market is always changing.
Yeah.
And investors need to be ready to change their strategies if they need to.
Uh-huh.
Don't be afraid to take a fresh look at your investments.
Okay.
Consider new info and make changes if you need to.
So it's okay to admit when you're wrong,
Yeah.
learn from it,
Mm-hmm.
and move on.
Absolutely. There's no shame in changing course if the numbers tell you to.
Okay.
In fact, that's a sign of a smart investor.
Right.
Someone who's willing to learn and adapt.
This has been such a great conversation,
Yeah.
and I bet our listener is already thinking about how to use these ideas in their own portfolio.
Right.
But before we jump into that, I think it's time to take a breath
Yeah.
and let everything sink in. We've covered a lot.
We have.
Welcome back to the Deep Dive. I feel like I'm so much more prepared to handle the market now.
Yeah.
After going through all of Dan Ha's ideas.
He gave us a lot to think about.
He really did, especially when it comes to making a portfolio that can handle anything.
Yeah. Now's the exciting part.
Yeah.
Putting all this knowledge into action in your own financial life.
Okay, let's get started. Where should our listener even begin? We talked about quality and valuation and
Yeah.
diversification.
Right.
But how do you actually put all that together?
A good place to start is to look at your current investments with fresh eyes.
Okay.
Are you spread out across different types of investments like stocks, bonds, real estate,
Right.
and all that? This might sound super basic,
Yeah.
but you'd be surprised how many people forget about it.
Yeah, it's like don't put all your eggs in one basket.
Exactly.
Right.
But diversification isn't just about having different types of investments.
Right.
It's also about spreading things out within those types. Like
Right.
if you've got a ton of your stock portfolio in tech,
Yeah.
maybe think about getting into some other sectors that aren't so connected to tech.
Okay.
Remember how I mentioned that business services tend to do pretty well even when the economy's not doing so hot?
Uh-huh.
That could be a good area to look into.
So maybe look at healthcare or consumer staples
Right.
or even those kind of boring but necessary businesses that Hal is so talking about.
Yeah.
The ones that people always need no matter what.
Exactly. You want a portfolio that can handle different economic situations.
Makes sense. So once you've got diversification figured out, it's time to really dive into Ha's main idea, quality.
Right.
But it's worth another look because it's so important to his whole approach.
Absolutely.
Okay, remind us what quality actually means when we're talking about investments. How can our listeners spot a high-quality company?
Remember those moats we talked about?
Yeah.
Quality companies are the ones with the toughest moats.
Okay.
They've got that lasting competitive edge
Uh-huh.
that lets them keep making money even when there's tons of competition.
Right.
They've got great management teams, innovative products and services,
Yeah.
and a loyal customer base.
Okay.
These are the companies that are going to stick around.
So it's not just about chasing the hottest stocks or the latest trends.
Right.
It's about looking deeper
Mm-hmm.
and finding companies with a real track record of success.
Exactly. But here's the thing.
Okay.
A high-quality company can still be a bad investment if you pay way too much for it.
Yeah, that makes sense.
That's why valuation is just as important as quality.
Okay.
You got to make sure you're not overpaying for a company's stock,
Right.
no matter how awesome their business is.
This is where it can get a little scary for the average investor.
Yeah.
How do you figure out what a reasonable price is for a company's stock? Any advice for our listener who might be feeling a bit lost here?
Don't worry, you don't need to be a financial whiz to understand valuation.
Okay, good.
There's so much info out there.
That's good.
There's so much info out there.
Right.
The websites, books, financial advisors,
Yeah.
they can all help you understand the important numbers.
Okay.
Don't be afraid to do your research, ask questions, and get some help if you need it.
Right.
It's your money, and you should understand where it's going and why.
So do your homework, compare companies,
Right.
and make sure the price makes sense for what you're getting.
Mm-hmm.
It's like buying anything else. You want a good deal?
Exact. Now, remember what Haas said about focusing your portfolio on a smaller number of these really great companies.
Yeah.
It might sound a little strange
Yeah.
since we've been talking about diversification.
It does seem like we're saying two different things. So
Right.
how do we make sense of that?
It's all about balance.
Good day.
Diversification is still important,
Uh-huh.
especially across those different types of investments.
Right.
But when it comes to stocks, Haas' idea is that focusing on a few truly fantastic companies that you really get can actually lower your risk.
Okay.
It's like carefully choosing the best ingredients for an amazing meal.
Right.
You wouldn't just throw in everything you can find.
Yeah, that makes sense.
Right. You'd pick the ones that go well together and make a delicious dish.
So it's not about having the most ingredients.
Right.
It's about having the right ones.
Exactly.
That's a great analogy. So let's bring it back to our listener and their own investment journey.
Yeah.
What's the one big takeaway they should keep in mind as they navigate this complicated world of investing?
I think Haas's most important message is that investing is a long game.
Okay.
Don't get distracted by what's happening in the market every day. Focus on finding those high-quality companies, the ones with solid foundations and a clear path to growth over time, and hold on to them. Remember, patience is key, especially when you're trying to build wealth.
That's a great point to finish on.
Yeah.
Stay informed, do your research, and remember that building a successful portfolio takes time, patience, and a willingness to learn and adapt along the way.
Couldn't have said it better myself.
Well, that wraps up our deep dive for today. We hope you enjoyed exploring the world of economics with us, and that Dan Haas' ideas have given you something to think about.
A lot to think about.
Until next time, keep learning, keep exploring, and keep diving deep.